Everyone, this is Rob Roy of Elliott Wave Options, and welcome to this week's U.S. market updates. A little after the close on Friday, August 11th. By the way, before we get further, if you like these videos, please hit that like button, or better yet, hit subscribe, and you'll be notified immediately when one of these videos is posted. Thanks. We really appreciate it. You know it helps. You know how the deal works. Well, when we talked in our live market update, and if you'd like to subscribe to that so you can join us every Friday at 2 p.m. Eastern time for our live show. We do a live Q&A, talk a little bit about what's going on in the market at that point in time. Go over to the Hub Financial channel here on YouTube and subscribe there. That way you got it both covered. You got the live show covered and you got the market update here. So love to have you on both of them. And when we were doing the live show, it made the comment on how, in a few of our previous live shows, the market had been up, and then after we finished the live show, the market sold off into the close. Didn't really happen on this Friday. Where we were was we were going through a bit of a sideways movement, not a great looking triangle, so the fact that it didn't significantly break out is not surprising, but we did move a little bit to the upside into the close, and you can see right there where we finished on the close. Well, we had a lot of interesting news come out this week, starting off the week with the Moody's downgrade of the regional banks. And that put a pretty negative tone on the market. We sold off pretty hard. We did recover a bit, but I thought I'd show you a chart here of the KRE while we're talking about the regional banks. And I think you'd have to say, all in all, it's held in there pretty well. This could have been a big down day. We were down like 450 points on the Dow at one point, I think, and closed down 150. So it could have been a really nasty, ugly day. Didn't play out that way. You can see, which is really classic Elliott wave on the chart of the KRE, which is the regional bank ETF, a bit of a symmetrical triangle here. It's not that large, but Elliott always said, don't diss the small triangle. Pay attention to those as well. We always look at the big triangles for breakout opportunities, but the small ones matter. So what we're going to see here is some sort of a breakout on the KRE, I think, next week. I think we're that close to some sort of a move. Now, we don't know whether the move is going to be to the upside or the downside. And you could look at that wave 3 and say, oh, well, it's clearly going to be to the upside. One of the rules that Elliott stressed so much, not just in the general rules, but in his writings as well, is you don't pick direction on a triangle. A triangle can break either direction. Now, if we break down out of the KRE, I think that's going to be a struggle for the markets next week. But if we break to the upside, it could be no harm, no foul. Here we go, back to the upside on the S&P and the rest of the markets. So coming over back to the S&P, we also had the CPI report that came out yesterday, and that was a little lower than expected from an inflationary standpoint. So that part looked pretty good, and you're thinking, okay, the big news on the financial networks was more ammunition for the Fed to stay paused. Then today, we get the PPI report that came out. That's wholesale prices. Now, that ticked up. So what's the problem there? It is a problem. So if you have a less than expected inflation on the CPI, that's, going out and buying, that's the consumer. And then when you have the PPI, which is the producers, and theirs goes up, so that means on a wholesale level, wholesalers are having to pay more for their goods, but with the CPI coming down, prices that are being able to be asked for during retail pricing goes down. That crushes margins. That hurts margins. So that's something to watch. It's only 1 month. We'll see how it plays out over the next couple of months. But that's a pretty interesting scenario there. We did have the Bank of America. We talked about this a bit during the week, at least on Thursday night during our insiders meeting, which is for subscribers only at evotrader.com. They have their own webinar with an extended Q&A, how Bank of America released data that people were taking out money from their 401ks at an alarming rate. But if you read between the lines, it basically showed that it's retired people that are taking money out of their 401ks using the hardship clause. But younger people that are still working, all's fine. They're making their contributions. Everything is a bit normal. But it's costing people more in retirement to live. You would expect that with the higher inflationary data. So that's on the consumer side. But when you start talking about wholesalers having to pay more, not being able to up the pricing from the inflated prices that we already have, it's going to compress margins. That's a concern for the next earnings cycle. So anyway, just wanted to throw those things in there. So back to where we are on the U.S. market, you can see that we are likely moving down, I think, my opinion, towards this 440 level. So heading to the downside here, and you can see right there at 440, we fill this gap that almost got filled today. That little gap, the 50-day moving average support, filling that gap, kind of makes sense that 440 is a landing point for the SPY. We're below the 10-day moving average. As you can see, as I pointed out earlier, there's that bar where we did close a little bit higher from where we were at 2 p.m. Eastern time in our live show. Not much else to say about the S&P. Looking at the 10-year, now the 10-year is also troublesome or worrisome. Not trying to be a negative Nelly here, just reading the charts and pointing things out to you. During Tuesday night's TradeFinder and over the past TradeFinders, we've been focused very heavily on the TNX and the bond market. By the way, we do TradeFinder every Tuesday night at 9 p.m. Eastern time. It's free. All you have to do to register, go to our website, evotrader.com, and you can join us each and every Tuesday night. We talk about the markets, we look for trade ideas, and we have a live Q&A at the end there. We've got a great community that joins us each and every Tuesday night. Love to have you come along. It's a lot of fun. But one of the things that I've been trying to do is add some education as well. And you've got to have, in my opinion, at least a working understanding of the bond market to be a good equities trader. So that transfers into options as well. There's more money in the bond market than the equities market, and it's widely regarded that the smartest traders are in the bond market. So pay attention to what's going on in the bond market. Now, for the longest time, for those of you that have been watching us for quite a while, we've highlighted this range between 34 and 40, which 40 equates to 4% on the 10-year. And we broke above it, and we went kind of vertically up, took out that wave 3, so now we've labeled the wave 5. And then the question was, are we going to come down and test this 40 level? And that would be key. What happens when we test that level would be key, especially for those Magnificent 7 and the tech stocks and the Qs. We'll look at the Qs in a minute. And look what's happened over the past 2 days. Boom, boom, back to the upside on rates. That's going to be really challenging the longer we stay above 4%. And if by chance we're to move higher, our tap box time and price projection out of the Hub Financial software here, which to me is the greatest Elliott Wave software program that exists. You can find out more about it at hub.com, HUBB.com. There's a lot of Elliott Wave softwares out there. Most are personal adaptations. This is programmed exactly to Elliott's algorithm. So that's got us up at 4.3 on the 10-year. So a continued amount of time above 4% is just going to grind into those tech stocks. It's a little too high, and it's concerning as to what's causing this. Why are rates continuing to go up like this? We just had a better than expected CPI, slightly worse PPI. So everybody's kind of thinking maybe the Fed's at bay. What's causing this? And when you have these kind of unknown things, it's unsettling. So lots of stuff to watch in next week's trade. Do we continue to run to the upside here on the 10-year? The dollar staying stubbornly strong, just right up here. Now, we don't have an end-of-day print here yet. I know currencies just like Bitcoin trade 24/7, so we don't have the end-of-day print yet, but I can tell you that we will take out this wave 4 on the closing print, almost up to 103. Not not a significant move, but it will move that wave 4 over just a bit. Still close enough to consider it a 61.8% corrective move. But this one concerns me even more than interest rates on the 10-year going to the upside, because if the dollar takes off and runs, we do have a 5-wave to the downside pattern here, and I think it would be great to see that move lower. But if the dollar takes off and runs to the upside, that means global weakness. They've all been talking about what kind of recession are we going to have? No recession, a mild recession. Some are now saying a heavy recession. Jeffries came out this week and they expect a hard recession. So, everybody all over the map on what the forecasts are. But if you see that dollar start to sprint to the upside and disqualify this 5-wave pattern to the downside, now you're seeing that indicates global weakness. People are running to the dollar to hide. They're viewed as a safety. They're viewed as the currency of last resort, the strongest currency. That's not going to be positive for companies either because of the exchange rate for companies with an international presence. And as you know, we have a global economy these days. So if we don't get this move to the downside, that's going to be troublesome for the markets as well. And it's definitely going to be troublesome for the metals. So here's SLV. We've been talking about this for a while. And by the way, as I'm going through these presentations, remember that you can use the chapters feature on the recording to go to a specific stock symbol that you're interested in seeing. So I'm putting up a lot of different symbols here. If there's something that you just want to focus on, use that chapters feature and go right there. But for here on the SLV, going back to the SLV chart, we have this level right here at 21 that we are desperately trying to hold. Look at these bars just hanging underneath that 21 level. And if we break that level, note we're not in a 5-wave pattern here. If we break below this, and I would submit to you, if there's much more follow through to the upside on the dollar, this is just going to give way. We've been looking for a bid in the metals as the dollar moves lower. Now, as it looks like the dollar wants to move higher, you could look for flip the script and a pretty nice downside trade in both the SLV and the GLD. So that's looking precarious. I've used the analogy in the past, so, fingernails holding on to a cliff. That's what the SLV is doing here at the 21 level. Note we've been a little oversold, so the fact that we haven't broken lower is understandable. If you are looking for a bid in the metals, then you want it to hold here. But gosh, when that 10-day moving average comes down a little bit more, if the dollar moves higher and we break this level, it's not a positive for the metals moving higher, but it would be a great trade for the metals moving lower. And what I mean by that is you can see we've had this nearly vertical move from 18.5 to 21. There's nothing there. It's just a gap. It's a vacuum. And if we break below 21, that's where we're going, to 18.5. So let's take a look at some of our other markets here. We take a look at the Dow, the DIA, hanging in there better than the S&P. So some encouragement there, other than the fact that the diamonds can be looked as a little bit of a flight to safety. The Dow is the top 30 stocks. So if you're looking to maybe pull a little bit of risk off the table, perhaps you move out of the S&P, the Qs, the IWM, whatever, into the Dow. So the key here, the level to watch on the DIA is 350. You want the DIA to stay above 350. As long as it does, closing above the 10-day moving average here, that's bullish. So this consolidation here above a support level is key. If it breaks below 350, then what happens? Well, we could have just a brief move lower. Maybe we hold some support here at that wave 3 high at 345. I doubt that would hold, to be honest. If we break 350, I think there's a high likelihood we see 340 on the DIA, and then we'll reevaluate from there. But it's got to break 350 to the downside first, and from this setup, you could easily see this consolidation and a move higher. So kind of a interesting time on the Dow. The Qs, they're weak, as you would expect. I just went through why with the 10-year and interest rates, and trying to, through TradeFinder, help people get a little bit more of a working knowledge of how the bond market interacts with equities, commodities, etc. We are, gosh, right on the 50-day moving average here. We've got a little bit of a doji here. Notice this doji on the Qs right on top of the 50-day moving average. What does that mean for next week? Monday is going to be really interesting on the Qs. What happens with the 10-year? Do we bounce here? I mean, we're at the 50-day moving average. Are we going to bounce back to the upside from here? Or is that a sign that we're probably coming down here to 360? So some sort of movement out of the Qs early in the week, like Monday or Tuesday, I think is going to materialize here. We're a little oversold, so maybe we bounce back up to the 10-day moving average, but I would not be surprised to see us break down to 360. Now, you want 360 to hold if you're long the Qs, and I know a lot of you are because of the Magnificent Seven and all those stocks, but man, if we don't hold 360, we're down here looking at 340. That's going to be the key next level, and that's not a huge amount of support there. The big support is all the way down at 320, which also happens to coincide. Look at this range. The two levels I've given you of support, 340, 320, are framing where that wave 4 projection is. And for those of you that are newer, haven't watched this before, this does not mean the wave 4 is underway. It's not labeled. We're still currently in a wave 3, just a bit of a pullback. So, I mean, we could move higher and create a zigzag to the upside here. But if we do break down and label the wave 4, this is telling you if the wave 4 is underway, here's where you could look to find support. And isn't it interesting how it happens to coincide with the 320 to 340 level? So that makes an awful lot of sense. Looking at the IWM, we had talked about this in the past. You know, we had the 170 to 190 range. I know those of you that have been watching each and every week know all this, but for those of you that are newer, 170 to 190 is the range for over a year on the IWM. Then we tightened up the range earlier in the spring to 170 to 180. We broke out of that, hit 190, came back, tested 180, broke above it, and then we surmised, well, are we going to come back down and test 190? That's exactly what's going on right now. So the IWM, the small caps, what a lot of people look at as some sort of an indicator of risk tolerance, is trying to hold that 190 level. So we'll see if we can hold that level and move back to the upside. If not, then that's almost a Katie bar the door thing. We're probably back down to 180. So we would have a relatively quick move, I think, from 190 to 180 if we can't hold here. We do have the 50-day moving average there as well. Looking at Bitcoin, my goodness, you have to be really impressed with how Bitcoin has held this 29,000 level. We did look at Coinbase in our Friday live show. So go over to the Hub Financial channel, check out our live show that we did earlier today if you're interested in Coinbase. But looking at Bitcoin here, if we can hold this 29,000 level, start to break to the upside with the halving that's coming up, the first quarter of next year. I've been really impressed that it's been able to hold 29,000. We did try to break to the upside back on the 8th, couldn't hold it, back down here. So we are stubbornly staying across that 29,000 level. Look at the moving averages. They're all at the same spot. 10, 30, and 50-day moving averages all right there on top of 29,000. Now, one of the things that I talk about living on the Space Coast in Florida is something called the launchpad effect. And that's when you get a sideways consolidation along a price tag. Sometimes you get a bit of a blast off, see the analogy, from that sideways consolidation. So the sideways is the launch pad, and then you get the blast off move. Is that what's going to happen at a Bitcoin? If we break down below 29,000, though, we're going to see 27,000 easily. That should happen very quickly because of how vertical this move was, up from 27,000 to 29,000. And we could even go a bit lower, all the way back down to this wave 3 high from February, and 26,000 could be the target. So my question for you, I'm curious, I know a lot of you are interested in Bitcoin, and it's held in there pretty well, kind of interest coming back. It had gone away for a while. What do you think's the next move on Bitcoin? Do we get the blast off move to the upside? It could be a very quick move to that recent high at 32,000, or is it a really quick move back down to 27,000? So my point here is I think as Bitcoin breaks from this consolidation, it's either going to be a pretty fast move to the upside, 32,000, or a pretty fast move to the downside at 27,000. Which way do you think it's going to go? Post a comment. Love to hear from you on where you think Bitcoin goes from here. Big move up, big move down. I don't think we're going to have to wait much longer. That's been a pretty extended consolidation. I think we'll get the signal pretty soon. A couple quick international markets. The EWA, I'm bringing this one up because this one has just been stubbornly in this trading range between 22 and call it 23 and a half, just below the 24 level. And it's happened since we broke into that level in February. Back and forth. It looks like a great sideways trade, but by now, the problem if you put a sideways trade on when you've had this trading range for so long is we're probably closer to a breakout than we are continued sideways. When I see that kind of thing, I like to look at the ADX. The ADX is an indicator of strength of a trending move. So when you have a low ADX, it means trendless. And that coincides with consolidation, triangles, etc. And you can see the ADX has been diving back down. It's below 15. So the ADX is kind of telling us, yeah, we've been consolidating for a while now. We're probably going to get a breakout. So either going to break below 22 or above 23 and a half. I think it's a great trade either way. You break below 22, you got a great downside trade. You break above 23 and a half, you got a great upside trade. So I think you'd be a little patient here on the EWA, on the Aussie market. You'll be rewarded when it breaks one of those two directions because you'll have a nice directional trade at that point. The INDA I wanted to show you because it's like, it's that fingernails on the cliff type of thing here. It's been such a strong market all the way from those lows in March. We've given a little bit back. So that's the negative, is we're giving some back here. We broke below a little bit of that consolidation today. We had talked about that in TradeFinder Tuesday night, as well as our insiders meeting last night. But then today we break down, but note the positive, we didn't even make it to the 50-day moving average yet. We had a nice run here, a very long trend, the kind of trend you want with that 45-degree angle move. Perhaps this is just a normal corrective move back to the 50-day moving average, and then the INDA is poised to move back up towards that wave 5. We're going to know more, in my opinion, with how it handles the 50-day moving average. A little bit of concern that we're below the 10-day moving average. That's your shorter term trending average, but the longer term one is the 50-day. If we can hold the 50-day in bounce, I think it's no harm, no foul. The INDA continues its run. But if we break below that 50-day moving average, then I have to think if you've been in this and have some profits, you might want to look to take those and let it play itself out. Couple stocks of interest. Nvidia was in the news as there was some commentary from some analysts that Nvidia is done. This way overbought, which it does have an extreme multiple. Its multiple is even higher than Tesla, which is amazing. So can we hold in this area? And if we do, I think we're okay. So we're nearing an area of support here on Nvidia, but we did break the 50-day moving average today. That's a concern. There's some support right there, plus the big round number. Y'all have heard me talk about my old analogy, Star Trek. Gosh, my dad was a huge Star Trek fan. It was on every night. And the tractor beam, I heard that all the time. But it's a good analogy of what happens with these big round numbers. The tractor beam effect of drawing the stocks to them. So I think we find 400 on Nvidia, especially now that we broke the 50-day moving average today. But, you know, we had some support there going back to May and June. Can we hold there? Hopefully. If we can hold there, we have the opportunity to bounce. If we get a continued move up in the 10-year with rates and the dollar stays strong, that's going to be pretty challenging. It's possible that we could hold there at 400. If not, then I think you have to say, all right, begrudgingly, we're probably coming down to fill this gap. I know those of you that are long Nvidia have done very well on it, wouldn't want to hear that. But That's the way it looks from a chart standpoint. So to wrap up Nvidia, watch 400. It needs to hold that. It breaks below it, I think you bail. If it holds it and bounces, gets back above the 10-day moving average. So I'm going to be real clear here. Just a little bit of a bounce off of 400 is not enough. It's got to bounce back above the 10-day moving average. So we need to bounce back above 440 before I would look to go long. So if you're long right now, hang on. Breaks 400, you're out. If you're looking to go long, don't jump the gun here. Let it break above that 10-day moving average at 440. Looking at Disney, I thought this was a really interesting stock this week. Kind of near and dear to my heart as I live near Disney in Central Florida. I'm over on the coast, but it's not that far away. And, you know, we've gone through and recounted in various webinars all the negative news that's happened with Disney from the issues with the governor of Florida, all the political stuff that's going on, content waning a bit on their Disney Plus streaming channel, and then the fact that you got the Hollywood strikes. It's like, how much bad news can one stock endure? We get the earnings report, and so the earnings report comes out, and it's not able to knock the stock down below 85. So the fact that we didn't break below 85 on Disney, I think, is very telltale. And I mentioned this in our live show as well. We have a number of subscribers at ewotrader.com, our alert subscribers, that look for longer term positions. They want leap positions, and leaps are long-term options, long-term equity appreciation securities is what leaps stand for. And it allows you to take a longer term position in the stock without still paying the price for owning the stock. I think this is a candidate here. They had the earnings report. Earnings report was bad as everybody thought. So the wonderment was, it's a bad earnings report, going to break it below 85. Well, management was smart. They started talking about AI, how they were going to integrate it through all their business models, and the stock shot up. I was watching it live after hours, and as soon as they mentioned that in the conference call, the stock moved to the upside. It held a little bit of give back today, but we'd gotten overbought yesterday. We're still above the 10-day moving average on Disney. We're looking at this level of 90 as an important level right through here. I think if you're looking for something longer term, you don't want to deal with the day-to-day volatility. I think you could take a look at Disney as something for a leap. Come back and look at it a year later. I think you might be pretty happy with the results. Speaking of volatility, let's wrap this up with the VIX. We ran up again to hit that 17 level. So 17, that was support throughout April and May, has now clearly become resistance. We came up and tested it here in July, turned back, and we've been peppering it here through August, just constantly, bouncing our head against the ceiling here of the VIX at 17. So far, unable to break above it. We kind of moved to the downside on the VIX into the close today, and so we're in the 15s. And we take a look at the 10-day moving average here and close dead on the 10-day moving average. So a little bit of room if the market does want to rally. We built support down here at 13 on the VIX. So from 15 to 13, we've got some room on the VIX if we want to rally. And if the market does roll over, I think this constant, pounding of that 17 level, if we're ever able to break through that ceiling, it could be a big spike in a short period of time on the VIX, and that would be a significant move lower on the markets. Last comment, I'll wrap this up. The markets did have a chance to have a big sell-off with that Moody's downgrade of the regional banks. It was a down day, but way off of where the lows were, not nearly as ugly as it could have been. So I don't know if we're to the point where we're going to have a big down move yet, but gosh, the markets are really interesting now. Stock pickers market, that's what we try to help you with here at the U.S. Market Update. Thanks for watching. Have a wonderful weekend. Look forward to talking again soon. Take care, everybody. If you like these recordings, I'd like to invite you to join our new TradeFinder Live, where each and every week we do a live webinar where we talk about the market, but we also go a little more in depth into the technical analysis system that we utilize to forecast where the market's likely going to go, and also to identify trading opportunities. Get your free subscription today. Take care, everybody.